Good morning, ladies and gentlemen, and welcome to the Shanta Gold Q3 production and operational update. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just please simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and will publish those responses where it's appropriate to do so, and these will be available via your Investor Meet Company dashboard. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you give that your kind attention, I'm sure the company will be most grateful. And I'd now like to hand over to Eric Zurin, CEO from Shanta Gold. Good morning.
Yeah, good morning, Mark, and thanks everyone for joining to hear a bit more about Shanta's Q3 results. I'll take you through the presentation, which is on our website, and I want to do a couple things. The first one is to keep you abreast of how we're going at the New Luika gold mine in terms of production. But really, I want to focus on the growth in the plan across all three of our assets and give you a flavor for some of the catalysts to expect over the coming months. I think that's really important for Shanta and the equity story. And specifically, because I get this question over and over and over, how do we fund it? Is there a risk of an equity issuance? The answer is no. There is no risk of an equity issuance. We have cash on the balance sheet. We have very good liquidity. We don't have any debt, and we generate cash from our assets. So let's put that question to bed first and foremost. And let's really just focus on, let's get excited here by what's in the growth plan, because the next 12 months could be really transformational for Shanta. And I really mean that. You know, we're going from one asset to three, and there's all sorts of catalysts across these three assets. So without further ado, I'll step into the presentation now. I'm going to turn off my screen for a few minutes while I do that. And we'll take some questions at the end of it. This shouldn't take long. We'll probably be done by the top of the hour, and everyone can go back to what they were doing today. Now, why don't we just start on slide 3? Because it's probably just worth recapping for anyone who's new to Shanta or anyone who may need a refresher. Shanta is an AIM-listed gold company. We've been listed now for, I think it's 16 years on the AIM exchange in London. We're capitalized at about $200 million. It's about 140 million sterling of market cap. We don't have any debt. We're unhedged. We have, I think it's $22 million of cash on our balance sheet. Sorry, I should say we have $1.4 million of debt, so very little debt. $22 million of cash. We have liquidity of about 28 million. So there was, at the end of the quarter, there was about 3,000 or 4,000 ounces of gold that hadn't been sold, that were sitting in our inventory. And we pay a dividend. And so this dividend is very new. We've now, next week, we'll pay our second dividend as a gold producer. So we paid our first one in April, a second one in October, and combined, we're yielding about 1.4%. You know, so about an infinite times better than what you'll get in your HSBC account. You know, but we're certainly not a dividend company. We like to balance income and growth, and frankly, I think it's a good discipline to have a dividend in the company. We're backed by a number of really interesting shareholders. As you can see here, Fidelity has just gone up to 5% this past quarter. BlackRock is on the register at 3.9%. Odie's been a very long time and very supportive shareholder at 11.6%. Sustainable Capital has been very patient as well with us, and they've been very supportive along the way for the last 4 or 5 years, and they've been holding steady at 6%. And then I think River Mercantile, who also has been a long-standing shareholder, they're London-based, very high quality name. And I believe they've just increased their position as well this past quarter. So, you know, a good breadth of institutions, and supported by retail investors like yourselves who are here listening to the story, want to hear more. We're happy to give you the information so you can make your own decisions on what you think about Shanta. Now, let's just go on to slide 4, if we will. And this was a slide we prepared and presented back in July during the quarter. We announced our 5-year plan. It was a plan that the last time it had been announced was in 2017, so quite a long time ago. What's different this time around is we have a forecast for 500,000 ounces of production over the next 5 years, roughly, coming from 2 assets instead of 1. And then we have a third asset, being the West Kenya project, possibly coming on stream in 2025. And so when you look at where we are today, 60 to 65,000 ounces of production will be moving into a diversified revenue stream tail end of next year with the Singita asset coming along, or early 2023. And that's really important because that, again, de-risks the overall company. Now, I should caveat the whole story around Shanta now has changed a lot in the last couple of years. Shanta is now in a growth phase across all of our assets. And that's driven by the following 3 things. These are really important. Reserve life extension at New Luika, construction, which adds obviously more ounces and diversified revenue at Singita, and then resource upgrade and resource expansion at West Kenya. So these are our priorities. If you just boil them down into 3 simple priorities, this is it. And we're investing across all of these assets. We're investing across these priorities because our numbers show, and I really believe, personally I believe this, that the risk-adjusted return for those 3 priorities is far better than the capital that we've got to put into them. And another way to say it is, Shanta could just turn off the taps, not invest in Singita, not build it, cut the exploration out at New Luika, hold out at West Kenya, do very little and try and build cash. But, in this market, I think cash is your enemy, in an inflationary period. You want to be allocating capital to growth and investments. And that's just exactly what we're doing. So the final point I make on this slide is that in 12 months, just over 12 months, we will be a gold producer with a run rate of over 100,000 ounces of gold production per year for the first time ever. And that's through the combination of Singita coming into the pipeline. Now on to slide 5. And just to focus on a couple of key numbers here. The first one here, during the quarter, we produced 14,194 ounces of gold at 2.2 grams per ton. So not dissimilar to our second quarter. Liquidity remains excellent. As I mentioned already, we have $27.5 million of liquidity. So that's cash and gold bars effectively in inventory at the end of the quarter. We basically have no debt, $1.6 million it is in fact. And we have a lot of flexibility in our growth. So there's debt capacity, there's cash flow from operations, there's the ability to curtail, slow down, speed up our exploration plans. There's a lot of flexibility in our plans. And that goes back to this first point I made. There's no risk of an equity issue. If we get that question, it's because someone isn't paying attention. We're not going to issue equity. So then on to slide 6, and we'll get into some of the details on the third quarter results here first. But let's cover just a bit on safety, and just as a quick point here, because it's important. Safety remains excellent at Shanta. It's a core part of our culture. It's within our DNA of the company. And this is something a lot of companies can't say. We haven't had a recorded lost time incident in 1,414 days. So you're going back here to December 2017, and that's about 7.5 million hours worked where there hasn't been an injury. I think that's just phenomenal. And when I talk to the true mining engineers, the true guys who've been in the industry for 40 years, who've been in the depths of mining, they just say that, listen, Eric, if you do nothing else, just maintain that track record, maintain that standard. It's so important. And we benchmark it. It's in our KPIs. It's important. So let's go on to some of the highlights from the third quarter. As mentioned, we produced 14,194 ounces of gold, grading 2.23 grams per ton. And grades from the underground areas that we mined are holding well. So we remember back in July, we talked about grade control drilling. So that's basically narrowing the spacing, increasing the confidence of what you're about to mine. It's the equivalent of measured and proven reserves. So measured resources, proven reserves. And so we do that. It's expensive, but we do that because we want confidence. We want to know what we're going to mine is, or what we do mine is what we expect to mine. And so that's reconciling well over the quarter. But again, as outlined in July, this has been a challenging year. First off, due to an encounter with a fault at the depths of Bohemia Creek, and then overall lower grades in the plant. We aren't, if you look back here, the grades, if you go back to fiscal year 2019, 4.19 grams, last year 4.03 grams. I think if you go back to 2018, it was 4.5 grams. It is just what it is. The reserve grades are declining because we don't have this incredibly rich ore body called Bohemia Creek to rely on. That's absolutely fine. It's just, it's nothing to cause alarm. We don't have any hedges. We don't have any debt. We have a much bigger plant. And so, grade is one thing, but you have enablers to counter that. And that's what we have. So we've reiterated guidance this quarter of 60 to 65,000 ounces for the year, which, if you do the math, points to a slightly stronger quarter four, which we believe is achievable in our numbers. So again here, why is this all happening? Why is the grade lower? What do we expect next year? Is this time to hit the panic button? So the answer is no. And the mine plan is transitioning out of Bohemia Creek, which is this really rich deposit that served Shanta really well for about 8 years. And now we're going into new areas that bring us new life, like the Luika underground deposit, like the Bohemia Creek East Area 1 target. And during the quarter, what we did is we fast-tracked orders and deliveries for equipment, and specifically a jumbo. What does a jumbo do? It gives us more development meters, so we can get into these new areas faster and sooner. And that's really important for two reasons. One, it de-risks the overall plan for 2022. And two, it starts to deliver development ore. And so the jumbo we took delivery of, I think it was September 10th. And, trust me when I say it's fully operating now. So that's given us more capacity to do more development and de-risk the plan. Now, the team's working incredibly hard at site. They're doing an excellent job of delivering physicals. So these are effectively tons to the processing plant. And as you can see here, the second line, the second row, tons ore milled is the best it's ever been. 223,000 tons milled in quarter three. I'll get onto that on the next page, but it's a new record. Now, final point again, as I said earlier, all sales were done at spot, averaging $1,790 per ounce, as we are fully unhedged. And that's much better than where we were last year. Now, onto this process plant expansion on slide 8. And as I mentioned, the team's done an incredible job delivering consistent volumes of ore through our processing plant. So the current run rate now in the plant of 2,428 tons is 40% better than what it was when I took over this job in 2017. So that gives us a lot of flexibility in managing our overall grade, and basically spreads our fixed costs over ideally a bigger production base of gold ounces, but at least over a bigger production base of tons ore milled. In April, we estimated the new run rate would be 2,300 tons per day. We've done about 5% better than that, and it's consistent. The plant, I've said for many, many years, the plant has been an incredibly reliable part of the business. Long may that last. Please touch wood. The guys do a great job in the processing plant. So, my hat's off to them. I thank them. I'm pushing them to think of ways to get a fourth mill into the processing plant and maybe take us up to 2,700 tons per day. So we discussed that on site about 2 weeks ago. A lot of work's been done. We've had a lot of quotations for costs, and not quite there yet on making a decision, but certainly an exciting part of the plan if it materializes. Okay, so now on to West Kenya, because for me, this is a really, really exciting part of the overall Shanta equity story. Why? Because West Kenya offers exponential returns. It's as simple as that. You're not going to get typically exponential returns out of a producing asset. You'll get incremental returns as you add more ounces or as you expand the production base. Out of an exploration asset, particularly one the quality of West Kenya, you can get exponential returns. You can kind of have multiples on your investment. So remember, we paid $14.5 million for this asset just over 12 months ago, and it's guns blazing. So during the quarter, following phase one drilling, so during the third quarter, we announced an upgrade of 117,600 ounces, grading 7.0 grams per ton to the indicated resources category. What does that mean? Well, we basically infill drilled. So the inferred resources of 1.2 million ounces, grading 12.6 grams per ton, were drilled to a spacing of about 80 meters. So you drill a hole, you walk 80 meters, you drill another hole, you walk 80 meters, and so on and so forth. So you don't, you're kind of drawing lines in between those 80 meters. It's, put it this way, the banks wouldn't lend you money against that. So now what have we done at Bushingala, one of the two targets? We've drilled it to 20 to 30 meter spacing. And at Sulu, we've drilled it to 30 to 50 meter spacing. And it's a bit of an art. I mean, the geology at Bushi is more complicated than at Asula. So you have to drill narrower spacing to get the comfort of an external auditor to sign off on your resource estimate. So at Asulu, let's focus on that one because that one is by far the better one. We converted 82,700 ounces at a grade of 10.62 grams per ton to indicated. I mean, gold companies would dream of those kinds of grades, and they're delivering for us. So that conversion rate was at 130%. What does that mean? It seems a bit, how could something be more than 100%? Well, where we drilled, we actually found new areas. And so basically we thought there was, call it an ounce of gold where we were drilling. There's actually 1.3 ounces of gold following infill drilling. So that's very reassuring. Now, a point I want to make really is around the oxides, this is the area kind of 80 meters below surface, surface to 80 meters. These are very high grade, and we've added new oxides in the indicated category at both deposits. So very promising. What's next? What is this it for West Kenya? Definitely not. There's two parts more to the story here. The first one is more infill drilling at these two targets, Sulu and Bushingala. So we're targeting another 994,000 ounces to convert from inferred into indicated. So that'll happen over the next, it's happening now, and it's going to continue for the next 12 to 15 months. So our next update will be in the new year on how that's going in terms of conversion. And then the second part of the story, which I'll cover in a second, is the drilling regionally. So remember, we have 1,160 square kilometers of land at West Kenya, and it is definitely prospective. And I'll give you some indications of why I think so. Okay, so on to slide 10 of the presentation, where we've presented this slide before, but in a nutshell here, on the left-hand side, I showed here what the resource model looked like before we started infill drilling. So this is like the 2018 resource model. And what you want to see is when you do the infill drilling, when you go from 80 meter spacing down to 20, 30, 40 meter spacing, the model doesn't change very much. I mean, you don't want these incredible changes where, basically the first estimate was just completely unreliable. So the good news here is the model hasn't changed. If you look at the right-hand side, this is the new model of the upper zone, phase one zone following infill drilling. It's pretty much the same. And that's a good sign because the resource model is intact. It's holding. The infill drilling we're doing is converting at 100% or better. And the geology that we've estimated is intact. And I'd put that down to the team. Frankly, that's led by Yuri, who, he's been in this business for 40 years. He's not the kind of guy that's here to cut corners. He's been doing this all his life, and he does things properly. So, we're really lucky to have a guy like that on the team. So staying on the right-hand side of the page here, there's an area called IZ3.0.1. This is this dark red area. This is an area, again, where we added this high-grade oxide zone. I mean, as an example, we started here now with 15,000 ounces, grading 22.3 grams per ton in the oxide. So basically, the oxides mean it's free dig. You go down there, it'll be an open pit starter. You go down, dig it up, very little blasting, and it's incredibly rich. So it's very positive in terms of the economics for reducing the upfront capital to build the asset. So again, put this in context, we're now in phase 2A of drilling through to the end of the year. So that's about 23,000 meters we're going to do. In fact, I've just had notice about an hour ago that our third rig has absolutely finally arrived. It's cleared the border. It was at the border for a long time, and this is fantastic news. Capital Drilling's got it into Kenya now after a long battle, and so we'll be increasing our meterage. I think as of Saturday, we're going to have that drill turning. So third rig in place on the weekend. Okay, let's go on to slide 11. Just briefly, I think you may have seen this slide again before. Very brief. So Liberum, one of the research analysts covering us, has benchmarked some of our grades drilled against global peers, listed on the Canadian and Australian exchanges. And what we see here is, Shanta, number 2 position, 4 meters at 706 grams per ton. I mean, it's kind of beyond Bonanza, really. Bonanza being an ounce per ton at 32 grams. So, looks pretty good in my mind. And this is kind of catching the attention increasingly of more and more corporates who are sort of scratching their head thinking, what's this all about? We've never heard of this asset before. It's frankly because it's been tucked away in a major for many, many years. So a lot of positive developments, and I think it's getting noticed. On to slide 12 here. They say a picture is worth 1,000 words. As we've reported before, I wanted to use a few visual aids to illustrate the quality of the drill core that's been achieved at West Kenya. 2 points worth making. The first one, the spectacular visible gold is being reported from surface right down to 700 meters. Remember that graphic or that long section a couple of pages ago where I showed all the dotted yellow areas on the right-hand side of the slide? That's the visible gold we're seeing. And, visible gold is usually a pretty good indicator of good resource potential. So the geologists are thrilled to be getting that. The second point I want to make is that, we've now started drilling across the regional targets. There's one particularly called Remula. Honest is going to be in, our head of operations and technical. He's going to be in Kenya. I think he's there now. And he's off to Remula with Yuri. We've had visible gold at Remula. Remula is a bit different. It's a sub-horizontal deposit. And we haven't spoken so much about this one, but Acacia had drilled it. The previous owner, Aviva, had drilled it. We believe there's potential to fast track to an inferred, possibly an indicated resource at Remula towards the end of the year. And we're drilling there now. One of our 2 rigs today is at Remula. It was sent there a couple of weeks ago, and the first hole they put down had visible gold in right through 4 veins, so 4 instances as it drilled from surface. So again, I don't know the assays, otherwise we would have reported them. But I caution you just to wait for the results before we make any conclusions on the target. But there's VG at Asula, there's VG at Bushingala, and there's VG now across the license holdings, across our tenements. A quick word on Singita on the next slide before we go on to VAT and some of the catalysts. Now, Singita is our second asset in Tanzania. It's the one we're currently have in construction, aim to have in production early 2023. I had a question not too long ago, has it been delayed from late 2022? Absolutely not. It's literally just someone suggested we put it on the other side of the calendar year, so into early 2023. So that's where we are. That's what we're targeting. Good news is we are expecting to take delivery of some of the key equipment in I think it's in December, and that's being shipped from South Africa in not too long a time. And last week we had what was called the first blast, quote unquote, at Singita, which was done at the Gold Tree deposit. So that's the symbolic first blast where they the emulsions in the ground, they clear the area, they blast the ground, and they start the load and haul process. So it's basically it's a sign of the point of no return. Really, it's sort of wetting the head of the asset. What else should we report on Singita? Well, we've done grade control drilling this quarter, which is really important because that gives us confidence of the first production when we start mining at Singita over the first year when it's in production. And so we've had some really good intersections out of that grade control drilling, and we'll be reporting that shortly. It doesn't change the overall resource picture. It just tells us and confirms with greater confidence what we already knew, which is there's an economic reserve or economic resource being a reserve at Singita. So pleasing to see that. Now, quick one on VAT, and then we'll skip to the catalyst. A couple points I want to note here on VAT is that audits of our VAT claims and payments or refunds of our VAT amounts have normalized. So in 2021, all the VAT that we've paid has been equally returned as a cash refund or a corporate tax offset. You can do the math there. Those final three bars, Q1, Q2, Q3, and it's in equilibrium. So that's kind of good news. The buildup of VAT has stopped, and we're getting this cash back, which we haven't been able to get on a timely basis. So there's regularity, there's predictability to the VAT now. That's very good news. The other point I want to make is that I met with the Revenue Authority about 2 or 3 weeks ago when I was in Tanzania, and there's a willingness to work together. They fully understand that to increase their intake of tax, they need to increase the overall tax base, and they do that by allowing companies to invest into the country. And, the easiest way to do that is to reinvest your VAT. So there's a sense that things are kind of getting back to normal, which is great. Now, where there's a bit of a sticking point is on this $23 million of historical VAT from July 2017 to June 2020. And we've always been of the view that that VAT should be refunded, and the TRA has come to us and said they'd like to amicably resolve it. We think that's a great idea, and obviously, the issue with Tanzania is that if everyone gets resolved at once, it's just a huge cash burden on the Ministry of Finance. So we're actively in discussions now with the government and the Revenue Authority about options to resolve this historical VAT receivable and to move forward. So nothing else to report there. As you can imagine, things don't move at lightning pace, and we're patient, but it's in discussions. Now, just briefly on the catalysts, and then I'll wind up. The way to think of the next couple of months really is around our exploration and our mineral resource updates. And as I said at the start of the presentation, Shanta is in the growth phase. We're growing our reserves at New Luika. We're constructing a mine at Singita. We're expanding and upgrading our resources at West Kenya. And so what should you expect to see? Well, expect to see drilling updates, expect to see resource updates, and expect to see us progressing with our growth in our plans, because that really is how we think Shanta can best demonstrate value and generate a return for our shareholders. And so that's, as you can see here, we've outlined some of the expected news items to come, which we'll deliver on. With that, Mark, I might pause there. That's the end of the presentation, and I'll hand it back to you to open up to any questions. Okay, well, maybe it's me here. So I'm on.
No, my apologies. Eric. I was just seeing if there were any other pre-submitted questions, but there weren't. So thank you for your presentation, Eric. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those questions submitted already, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. I'd also like to remind you that your feedback is important to the company as ever, and immediately after this presentation has ended, you'll be redirected in order that you can provide the company with your views and expectations. Eric, we did, as you can see, receive a couple of questions through your presentation, and I may ask you just to read out those questions and where appropriate to give a response, and then I'll pick up from you at the end.
Great, thanks, Mark. So the first question comes from Ramon O. And it reads, I would like to know what the expectation for production in Q4 is, given that grades in Q3 have been quite disappointing. So what we've reiterated today is that our total production guidance for the year is 60 to 65,000 ounces of gold production. And so we don't provide quarterly estimates, but we do provide an annual estimate. Now, I want to reiterate, the grades were in Q3 were according to what we expected from grade control drilling. So again, if you compare them to 2 or 3 years ago, yes, they're lower, but Shanta is in a completely different position to where we were 2 or 3 years ago. Now, what do we expect in Q4? Why should we expect Q4 to be the best quarter of the year? Well, a couple of reasons. One, we've taken delivery of another jumbo. And as I mentioned earlier, that adds development capacity. So underground development ore will now start coming into the plan. The real reason here for the jumbo is to de-risk the plan. We want to be able to access more areas and really de-risk the 2022 plan. But of course, as we're going through development, we get to collect some of that development ore. It's lower grade, but it's certainly economic. Now, as I said earlier, 2021 has been disappointing from a grade perspective, but it's been incredibly positive from a tons perspective. I mean, the processing plant now is the biggest it's ever been. We ran into this fault in Q2 at Bohemia Creek that set us back, and it's been a challenging year. But we have the resources in place, both in terms of financial. We have the growth plans in place. We have a clear strategy on how we're going to achieve all of these plans. And we have a fantastic team who's totally incentivized and focused to do that. Michael D has asked, everything looks really positive. What do you see as the greatest risk to your strategy? Well, listen, I think we're all in gold mining for the same reason, is that we think the gold price will go up. But of course, the gold price can go down and cause all sorts of headaches for gold miners. We are constantly evaluating our own cash flows. We don't hedge our gold exposure. Those days are gone. If the gold price goes down, we have to make adjustments to our plans. If it goes up, shareholders get to benefit. And so gold price is one that really is one, it's out of our control, so to speak. Now, also, I think a key driver here is cooperation with community and government, and hence my visits to Tanzania and Kenya. It's so important to be in front of our stakeholders and to make sure to reassure them and give them transparency in terms of what we're doing. That de-risks the overall production plan, and it's really symbiotic in terms of having a good, positive relationship with our stakeholders. So Albert C has asked, business looks on the right track and solid. Would you consider paying a higher dividend and conservatively leverage the balance sheet? Of course, we want to pay a higher dividend. It's a trade-off, though, because we have to balance more cash outflows with funding our growth. And so the way I like to think of it is we're not kind of 1 or 2 more dividend payments away, kind of 6 to 12 months before we really have the comfort that Singita will start to deliver ounces, and the capital investment we have to make will start to reverse in terms of cash flow generation. So, this time next year, I hope that we could be talking about a higher dividend and return more money to shareholders. I'm looking forward to my dividend check next week. It's great. In terms of leveraging the balance sheet, we always have that option to do. It's part of our toolkit. It's part of our financial flexibility. We like to be unlevered in the normal times, but of course we have that flexibility to use the balance sheet to ideally fund growth if we see the need. And it's part of our arsenal of tools that we can use as and when required. Sam M has asked, in your confidence of no capital raise being needed, is this all dependent on assumption on the VAT situation in Tanzania? No, absolutely not. As I'll go back to the 3 points. The first one is we have cash and liquidity on our, in our bank account of $27.5 million. We have no debt. So as the previous, person has just asked, could we use debt? We could, and we could do that quite comfortably. There's flexibility there. And then our third real tool here is, 3 and 4. Third one being we generate cash flow from our operations. And then the fourth one is you can always curtail certain areas of the growth plan if we had to. But, I think we'd probably look at financing through debt or other areas before we were to slow down our growth plans, because the growth plan is very exciting. Now, that being said, I am in Tanzania to talk to the Revenue Authority because I think a fifth source of capital before ever contemplating an equity raise is a VAT refund. And to date, we've never budgeted VAT refunds on an ongoing basis. We've taken the conservative view and assumed that anything we had returned was upside. But we're certainly getting very positive vibes from the Revenue Authority in country that it's time to welcome businesses in Tanzania and to expand the tax base, not shrink foreign investment. And so to do that, they need to be friendly on things like VAT, or at least law abiding on VAT. Andy C has asked, how are you going to get that AISC down to levels which start to turbocharge returns? Andy C, it is a point that we watch very carefully. The way, it's unit driven. So put it this way, if the grade was slightly better, the AISC would be much lower. And it's the physicals are the same, the tons milled, the tons mined. And we want to get back to, mining at a consistent reserve grade of closer to 3 grams per ton, not 2.23. So really, it's down to AISC. The other part of the coin is, we're constantly looking at suppliers. We're looking at our own internal costs. We do this on a quarterly basis for the board, and chipping away at areas where we think we can reduce costs. As you could imagine, it's like fingernails. Costs continue to grow, and you just need to keep cutting them on a regular basis to keep them sharp. Justin Y has asked, great update. Appreciate the significant ESG and community effort Shanta is making. Can you briefly discuss energy costs, impact, and the company's efforts on renewables, and if this will reduce energy costs? Thanks, Justin. Now, we've been working with FTI over the last 4 or 5 months on our own ESG strategy. We'll be publishing a sustainability report in the new year, which I've seen snippets of. We've done our materiality assessment. We've compared ourselves versus comps. We've interviewed a lot of our key stakeholders to get their feel for ESG priorities. And it's really exciting because it's an area of the business that has, I think, always been treated as incredibly important, but never really showcased. And this is really the first time we're going to actively showcase what we're doing from an ESG perspective. Now, in terms of our own carbon footprint, climate change, how do we treat the environment? Just to remind you, we operate in a forest reserve. It's incredible if you've had the opportunity to be in the new Louika gold mine. It's this beautiful area in a forest reserve. We take absolute care that what we do there is both sustainable and we act as good custodians for the environment. In terms of energy, the quickest win for us is to go on grid, so using state generated power, as opposed to burning heavy fuel oil, which absolutely just kind of keeps me up at night. The idea of big heavy HFO engines burning very very bad fossils. Very bad heavy fuel oil is just kind of unacceptable. So we're now up to 25-30% sourcing power from the grid. We meet with the supplier Tenesco to try and increase that. We have the equipment in place. We could take it up to 40-45%. It's the availability from Tenesco, which is our Achilles. They're just not providing it to us. It is in a remote area, and it's hard to get reliable power. But we have the capacity in place to take much more than we're doing now. So that's something we want to do. It's cheaper to take it off the grid as opposed to burning fossil fuels, and particularly where the oil price now at kind of $85 a barrel, you want to reduce that dependence. So we hope that'll ultimately happen. Working hard at it. Mark, that completes the questions. I don't see any others. So I might hand back.
You beat me to it. So yes, so thank you very much to all those investors that have submitted questions. And Eric, thank you indeed for taking your time to respond to all of those. If any further ones do come through, we'll make those available to you as well, Eric. As I said earlier, I know investor feedback is important to you, and we'll shortly redirect investors to provide you with the feedback. So I guess ahead of doing so, if I could ask you just for a few closing comments, just to wrap up with.
Well, thanks very much, Mark. And as I've said, on previous calls, and I'll say again, the quote unquote retail component of our investor base is hugely important to Shanta. We thank each and every one of you for being a shareholder, asking the questions, challenging us. We're here to interact with you and to give you and keep you informed, as transparent as we can be, within the rules of the stock exchange. And so this is the whole purpose of calls like this. Now, in terms of the Shanta story, I still believe, and if you look at it, where we've come from in 4 years, where we are today, hugely de-risked from a financial perspective. The balance sheet is pristine. 3 assets, a lot of growth in the portfolio, and a gold price which is pretty exciting, $1,750, $1,800 an ounce. With governments sort of printing money beyond what they should probably be doing. So, the fundamentals look good. Now, our job is to deliver the growth, deliver on these plans, to do it in a responsible way, and to generate a return for our shareholders. And, we're working day and night to do that. And I thank you for your patience. I thank you for your support. And we'll be in touch with more updates as they arrive.
Eric, thank you once again for updating investors this morning. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity for you to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the management team. On behalf of the team at Shanta Gold Limited, we'd like to thank you for attending today's presentation. That now concludes today's session. Good morning to you all.